Welcome to Private Lending Insights. I'm your host, Rocky Butani. In this episode, I interviewed Vance Hillstrom from Rubicon Mortgage Fund. They're a direct lender based in Lafayette, California, in the San Francisco Bay Area. They've been in business for almost 20 years and lending primarily in Northern California, but recently expanded into Southern California. They lend mostly on commercial real estate and a little bit on residential investment properties. We start off the interview talking about trends that Vance has seen with lending on commercial real estate in California. We talked about their lending guidelines. We talked about different asset classes that they lend on. We got some loan examples of deals that they funded, and we talked a little bit about their company. I've known Vance for many years. Rubicon Mortgage Fund has been a client of LenderLink since 2014. I've visited their office multiple times, seen Vance and members of his team over the years at industry events. They have a long history of funding bridge loans in California. They've got a good reputation in the brokerage community, and they've got lots of capital to lend. I hope you find this episode to be insightful. Here we go. Here's my interview with Vance Hillstrom. All right, Vance, thanks for joining me for this episode of Private Lending Insights. How's everything with you? How's everything at Rubicon?
Great. Another good year so far.
Awesome. Glad to hear. Tell us about some of the trends you're seeing in the market in Northern California or even in Southern California as of the last 6 months or so.
Yeah, I would say you're more of the same. I would say it's kind of rinse and repeat the last couple of years. So we're looking at just a ton of just a ton of transactions. I would say in normal times, we might see 100 loan opportunities a month and fund 10 of them. And right now we're seeing 250 to 300 transactions a month, and we're not quite funding 10 of them. We're probably funding 5 or 6 of them. So that's kind of the trend. It's a lot of not very many acquisition, lots of refinances. Refinances are tough to get through, and the ones that we're getting through tend to be cash in.
And to be, you said cash in?
Yeah.
Or, you meaning that the borrower has to put in cash in order to make the deal work?
Yeah, they're just not penciling. I mean, I call it kind of a collision between cap rates and interest rates. I mean, cap rates haven't really caught up to where, it's gotten better over the last 2 years for sure. Starting to get pretty close, but they're still not in equilibrium where it makes sense to go get debt at a conventional bank and buy a property, unless it's another user or a particular property that just makes a lot of sense, like a trophy property that somebody wants or something.
And are you seeing a lot of your existing loans requesting extensions?
For sure. So our average payoff historically is 12 months. And I'd say now it's closer to 2 years. So it's definitely been a longer cycle. And so, with Rubicon, all of our notes pretty much come with built-in extension options. We review each extension. Sometimes people do have to come in with cash in. I mean, that is part of our deal. But if we have good borrowers and they've kept up with their property taxes, they've made timely payments, insurance is all up to date. I mean, in general, we'll always extend. We have loans on our books that have, gone 7 or 8 years that were probably intended for 1-year deals.
Interesting. And are there any other common situations that you're seeing as far as why people need a bridge loan, why they're cashing out equity, anything you tell us related to that?
Yeah, so keep in mind, Rubicon's mostly a commercial lender. And so most of the deals that we're funding are commercial properties. Pretty much anything bought in the last 5 years is probably worth less than where it was purchased. Oftentimes these different bank loans, there's all kinds of loan covenants in there that they have to keep various things. And so we're seeing deals come up. And then obviously too, with up here in Northern California with First Republic Bank being taken over, a lot of those notes are not qualifying with JP Morgan. So we're seeing a tremendous amount of JP Morgan loans that were First Republic loans. And those are smaller balance sheet loans, which is what we tend to do anyway. We can lend up to to 15 million, but most of our transactions are 1 to 5 million.
And with those First Republic loans, what's the scenario there? Is it that the bank tells them, or I guess the new bank, JP Morgan, tells them that, hey, sorry, we need to we need to terminate your loan, or how does that work in terms of the loan term that they initially had with First Republic?
In a lot of cases, not all cases, in a lot of cases, banks have all kinds of documentation within their loan that if they want to cut the relationship, they probably can, especially when you've had a market that has moved down pretty good over the past 5 years and rates have spiked up, 5%. And so, First Republic, they were a great customer service friendly bank, and banking relationships meant a lot to them. And there was a lot of, they would really do loans at prices that other banks and other, people in the brokerage community just thought were ridiculous, because it was almost a loss leader for a lot of the business that they did. So a new bank coming in and taking these products over from First Republic, it just wouldn't qualify with a lot of banks the way they did things. So I understand what JP Morgan's doing. I think it makes incredible sense. At the same time, I understood what First Republic did. That's how they got business. So these loans, the only bank that would have been doing these loans would have been First Republic.
And are a lot of these loans that when they get terminated by JP Morgan, they have some sort of window and they say, hey, you need to get out of this loan, or you need to pay us off. When they come to you with those requests, are they generally decent loans on as far as the LTV and whatever you require to qualify for a bridge loan?
Yeah, for the most part. I mean, at some point they had to qualify with the conventional bank. So, not everything that qualifies with the conventional bank is going to qualify with Rubicon. In fact, our LTVs tend to be less than banks, oftentimes. Because we don't give the same kind of credit tool relationship. We don't have a depository relationship with our borrowers. There's a lot of differences, and we're much more on the asset. They can be on the credit, and they can be on global cash flow. And like my bank, for instance, would lend me money the way I would lend myself money. So based on relationship and global, what I bring to their bank puts me in better standing than I would put myself as a lender. So yeah, I mean, these loans are doable, but I mean they can look. We would require cash in and sometimes as well with those loans.
I see. That's where a lot of the cash in comes in. So where they might have their bank loan at 75% LTV, you're coming at, I mean, you're probably at 65% or less. So that's where they have to bring the cash in order to get that loan refinanced.
Well, yeah, what's really hard for people to understand this market. So let's say you would have purchased a property in San Francisco that's multifamily, there's rent control. And let's say you bought a simple 10-unit apartment building, and you have the same tenants today as when you bought it 4 years ago. And cap rates have gone from 3.5 to 5.5. All of a sudden you got a building that's worth 35, 40% less, and nothing has changed. It's the same tenants, it's the same cash flow, it's the same thing. And so there's a perfect example of how, I mean, the borrower hasn't done anything wrong. I mean, the tenants are still there. Everything's in place, but the value of the building, is less based on that cap rate change. And, it not only has there been a change in value, but in these falling markets too, banks tend to want more debt coverage ratios too. So
nothing's going to change, right? If their value dropped significantly when interest rates went up, it's not likely that their value is going to come up anytime soon.
Yeah. So let's say, for example, interest rates moved up 550 basis points. And let's just say, for example, cap rates moved up 300 basis points. Let's just say we'll use that as our set example. So cap rates are not going to move 1-for-1 with interest rates. So as you alluded to, it's unlikely we're going to see a 5.5% drop in interest rates to go back to where we sort of started. I think I've been a big advocate of, the Fed's dot plot is Whether you think Powell's slow, whether you think he's right on the money, it doesn't matter. At the end of the day, the Fed's been very consistent about their dot plot. They've been very consistent about where they've seen, what their projection for rates is. And for now, I'm going to take them at face value. So the Fed has made it pretty clear they're looking at probably 2 rate cuts by the back half of the year. My guess is these are 25 basis point rate cuts. I haven't seen projections much past that. So maybe the following year, maybe we get another 50 to 100 basis points. So yeah, I mean, over the next 18 months, do I think 50 basis points lower to 150 basis points lower is possible or probable? I will say yes to that. And with that, I'll say that I think cap rates adjust 60% of those numbers.
And as far as what you've seen in Northern California, not necessarily with your own portfolio, have you seen a lot of defaults and foreclosures happening in the market?
For sure. We haven't taken a property back probably 5 or 6 years. I might have 2 or 3 in default, but that's pretty typical. We pretty much typically have 2 or 3 in default. But we don't really get them back very often. I think I've taken back 6 properties in 19 years. So it's pretty unusual for us to get them back. But when our auditors came through, I mean, we use Originating McKenna, like a lot of people out there, and talking to them, they said that, the numbers were definitely higher across the board for private money funds, that in our case. But so, I talked to one fund manager maybe a month ago, and he said about 20% of his book was either late or behind or in default. I didn't get into too many details with him about it, and he's a Southern California lender and on a fund about our size. So yeah, I definitely think there's more out there for sure. But I also think that I think banks and private lenders alike have intentionally kicked cans down the road that it's kind of par for the course, so they're given their choices. That might be their best bet.
Okay. Let's switch gears and talk about some of your lending activity from the private lending data analytics platform that we see. It's called Forecasa. It shows that you funded about 50 loans last year and around the same in 2023, with last year being around $100 million in loans. Does that sound about right?
Yeah, that's about right. I mean, we typically, on a good healthy year, 100 million or so is pretty good. But I wouldn't be surprised if we did 60 or 70 million this year. We're just, from kind of what we did started the conversation, we're just not finding as many deals as we would like to. I mean, our whole team, everybody in private money, I don't care who you talk to, origination is the fun side of the business. From our investor standpoint or from my standpoint, if we get good borrowers that want to stay with us and they're a proven commodity to me and they want to extend and their loan still meets our lending criteria, I'm just as happy extending. But I mean, it's always more fun to go look at real estate, meet new people. Obviously, the sales team gets excited about, new originations, as does our inside staff. So it's always more fun to fund deals, but it's been a good market for us.
And so for 2025, you said expected probably around 60, 70 million. Do you expect that to tick up next year if interest rates are reduced by about 50 basis points?
100%. I mean, as soon as there's a turn in the interest rate market, I promise you activity will start up, not only for commercial, but for residential. And, 100%.
All right. And if you could break down in terms of, let's say, all the loans you funded last year or even just on average, what's the breakdown of commercial properties versus residential properties in your portfolio?
Yeah, so for us, it's really simple. We are 75% commercial and we are 25%, actually less. We're in true 1 to 4, we're 15%. And then our multifamily is about 20%. And then so what is that? 65% would be the balance would be commercial with our biggest holdings, industrial and retail.
All right. And with multifamily, so if let's say that's 20% of the loans that you fund, was that a lot a bigger number in the past before interest rates went up?
It's interesting. So multifamily, it's always been sort of the gold standard, kind of the easiest product in some ways to look at, um, the easiest to find financing for. I mean, lenders have higher LTVs that they'll lend against multifamily than just about anything. And so uh, it took this massive move in interest rates, and cap rates were so artificially low for so long. Um, it just, at least in the Bay Area, I mean, well located multifamily properties were comfortably trading in the 3.5 range, the 4.5 range, very comfortably, which I never understood. So we didn't do a ton of multifamily loans prior to, I'll say, the last few years, because first of all, you had other lenders with cheaper money. I mean, we're in an inexpensive private lender, but we're still not going to compete with conventional banks. But there just wasn't a whole lot of multifamily lending available out there unless you were going to do crazy LTVs, which we're never going to do. And so, yeah, for us, we've done way more multifamily lending than we normally would, just because values dropped, and people that were making, in my view, crazy LTV loans from the private side are wearing it now, and they don't have any cash to lend, and we're sitting there flush. So for us, it's easy, but I mean, I've seen these cycles before.
Sure. And as far as I've known you and Rubicon, which has been a long time, I think we initially met in 2013 or 14. It seems like
Whenever you started your business is when we met. But I know that.
sure.
Yeah.
Yeah, definitely. And it seems like industrial was always one of your favorite asset classes to lend on. Um, and there's always been some retail, but you've also done some other property types that a lot of other private lending shops wouldn't touch, like hotels, gas stations. Tell us about some of the other unique property types that you've lent on.
Yeah. I mean, in all honesty, industrial is my favorite property type. And the main reason is I understand it a little better than the others. And if you ever get it back, it's just a little easier to deal with. So, from that perspective, I love industrial buildings. But 4% of our portfolio right now is gas stations. So that's probably three, four, five gas stations. That's probably about right. Um, and then hospitality, it's interesting. So similar to multifamily, for a while, the hospitality industry really played in well to the conventional lenders. And you just weren't seeing them as much, not unless it was a smaller, nondescript, out of the way, secondary market, mom and pop kind of bed and breakfast. But I mean, like an actual hotel, you just weren't seeing those deals very much. But now we're seeing them again for the exact same reasons that we saw um, the multifamily, which I would also dovetail into office. Like I had almost no office on my books. And we've done not a lot. I mean, we've done more office than we've ever done. And, investors might be going, oh my God, I can't believe you're doing office. But it's like, I've got loans on our books that, you know, people were buying office buildings at 70 and 80% discounts, and they're willing to put down 50%. And we're sitting there doing 50% loan to cost on stuff that's literally 75% below the last price. But even then we're selective. So we got to find the right buyers. They got to have the right personal guarantee, the financials, building's got to be well located. So in this market, I mean, I would tell you hospitality and office, it's always the same for us. We're always where the people don't want to be. And where they don't want to be is whatever just blew up.
And how do you look at gas stations? What got you to be comfortable with gas stations over the years?
To me, it's an industry which I don't think is going anywhere for a long time. Um, People are going to drive vehicles that require gas. It's somewhat, I mean, yeah, maybe people drive a little less when the economy's not good and all that. But at the end of the day, I also believe that the tax, especially in California on gas, you can make an argument that this one of the state's biggest partner is the gas station industry. I mean, they charge almost $1 a gallon in the Bay Area. It's just a lot of tax revenue. And so I guess what I'm trying to say, you got these little small, well located, usually on a corner pieces of property. There's an active business in there. I mean, the convenience stores are usually doing pretty well, given their markups. And I just think it's a good business. Now, I will tell you that I think they've got a little bit rich in pricing overall, like where gas stations used to trade and where they trade now, and the spreads that the owners are getting on gas is so much more than what the spread is, what it used to be on gas. But some of that's just inflation. I mean, I don't know. I would tell you that it's a good business, and I would also tell you it's a business that a lot of lenders don't want to be in, and it does take a different set of qualifiers, but I think they're good businesses, and I've really never had a problem with the gas station. So.
And gas stations are, you've got real estate, but you've got a business behind them. It's a similar situation to a hotel. What about assisted living facilities? Is that something you ever lend on, and do you look at it in the same way?
I just don't know enough about it, and honestly, I am much more comfortable. I mean, it's kind of like where we lend money, right? We lend money everywhere in California, everywhere. However, I'm more aggressive in areas I know better, right? And I'm less aggressive in areas I know less about, and our pricing probably follows that as well. So, assisted living, will we do them? Yeah, but I would say there's lenders out there that are more versed in it that could probably be more aggressive than us.
All right. And speaking of lending throughout California, you said lenders that you know better. Obviously, we're talking about the Bay Area. What are the other parts of California that you know really well and really like to lend in?
It's easy for us to look at coastal properties in general, right? I mean, anywhere from, San Francisco to San Diego, up and down the coast, where there's population bases, it's not that hard to underwrite that and our resources are not as good in Southern California. So we're going to be a little less aggressive. But when I say less aggressive, I just mean with dollars. Our price, we sort of pride ourselves on being a pretty competitively priced lender. At the same time, though, we're just not going to push. We're only going to do deals we want to do. I mean, I say it all the time. We work for our investors. That's what we care about. I mean, we just want to be forthright and honest to people that call us up about loans. We want to tell them what we can do, what we can't do. Just be straight up. If we say we're going to do it, we're going to do it. But I mean, we're not afraid to say who we are, which is, we're going to try to win the deal with price and service. And if that doesn't win the deal, it's not meant for us.
And over the years, you've done deals in some more, I'd say, less populated areas of California. Let's say Central Valley, or even further past Sacramento, north of Sacramento, Lake Tahoe. How do you look at those areas? Are those still desirable? Obviously, at lower loan to values, or how do you look at those different areas?
Yeah, so a little different answer to some of those. So, like Tahoe, we know pretty well. So now Tahoe does have more volatility typically than the Bay Area. So we keep that in mind, but we understand Tahoe for the most part. Central Valley, it really depends where. We've lent all up and down the Central Valley. We have for 19 years. It's another one of those places that a lot of lenders just aren't going to get involved in there. And it kind of gives us an opportunity. So yeah, we're going to be less aggressive in the Central Valley than we would be in the Bay Area. But we're still willing to put out a good price. Like we don't really jack our prices too hard I mean, maybe a little bit, but not, I wouldn't use jack's not the right word. We're doing loans at the same kind of real estate in the Bay Area that we're lending at 8.75% or 9%. Maybe we're 9.25%, 9.5% in the Central Valley. And that's just because of location. And our LTVs might be 5 to 10% less, depending on what we're looking at.
And in the past, I've remember you've done a deal or two in Reading. Have you done anything north of that, like Eureka, or will you go north of, let's say, Reading?
If it's in the state of California, we're willing to take a look at it. Now, if we get pretty remote, I mean, kind of the problem is when you get too remote, is the deal sizes don't necessarily make sense for us to go do those deals. Like I've got this one outfit that calls me all the time. They're located in Reading. They call me all the time. They're sending emails. They send me emails all the time about deals. Problem is most of the deals are just too small. And so even some of these smaller loans, we're willing to do smaller deals, but we're probably going to have really long prepays and guarantee of interest because for us, if we just can't make enough money on the transaction as a whole, it just doesn't make any sense for us to do it. So, it's one thing if it's down the street and it's, a couple $100,000. It's another thing when it's, 500 miles away and it's a couple $100,000 or something. It's tough for us to do those deals. But yeah, we'll look anywhere in the state.
Okay. It seems like Southern California is an area that you've been a bit more aggressive in, or let's say at least willing to do a lot more deals down there. Are there parts of Southern California that you avoid? Besides the coastal areas, maybe you've got the Inland Empire, Bakersfield. Do any of those areas are they still desirable for you, or are there any that you avoid?
We'll look at anything. But yeah, I mean, the same areas, all your other client, all your other lender clients. Yeah, we're gonna lend money differently. And, when you start getting off the coast and get a little more remote, we're gonna lend it differently. I mean, some lenders probably won't do it at all, but, I do have a second home down in La Quinta, down in the Palm Springs area. So I'm getting to know that area more and more. I wouldn't be surprised to see us get a lot more active in that area.
All right, sounds good. We're going to get into your guidelines next and talk a little bit about your company, but let's take a quick break and we'll be right back.
Thanks.
Support for the show comes from Ross Diversified Insurance Services. All real estate investors and all private mortgage lenders need insurance. More specifically, they need the right insurance partner. For over 35 years, Ross Diversified has been the trusted partner for over 3,000 property investors and 500 lenders throughout the United States. If you're a real estate investor, Ross Diversified can help you whether you're managing a single rental property or a large portfolio of rentals. And if you're a lender, Ross Diversified can protect you with forced place insurance for when a borrower's policy lapses, or with REO insurance in the case of a foreclosure. They offer competitive rates and hassle-free claims assistance. Licensed in all 50 states, Ross Diversified understands the unique challenges of real estate investing and provides customized solutions to safeguard your assets. Visit their website, rossdiv.com, to learn more and request a quote. That's ROSSDIV.com. Please mention that you heard about them from LenderLink and the Private Lending Insights podcast. And we're back with Vance Hillstrom, Rubicon Mortgage Fund. Vance, let's talk about your lending guidelines. If you could just give us kind of a high level, tell us about your guidelines in terms of your minimum and maximum loan amounts, your interest rate range, and the loan terms you've touched on a little bit, but just high level lending guidelines.
Yeah. So, I would say I'll say 500,000 to 15 million. Our average deal size is probably just under 2 million. We're very comfortable, up to 10 million. We don't do any appraisals. So we literally do all of our own underwriting. And so we'll lend up to, I'll say 60% is our typical loan. However, right borrower, right product, right location, I would do 70, but it's got to be perfect. I mean, I hate to even say it because it's so rare, but I think a better answer is 65. We tend to be a little more aggressive on acquisitions than refinances. Interest rates. I mean, I quoted a deal today and it wasn't that big of a deal, but we just really liked it. We quoted the 8.991. So I'd say interest rates in today's market, 8.75. We don't quote a whole lot above 10.75. Really nothing. But 8.75 to 10.75. Average quote probably coming right out 8.99 to 9.25. That's probably average quote for most stuff we're looking at. And the fees, it depends on the deal size. It could be 1 to 3 points. Sometimes if the deals are really small, we'll just have a flat fee, 7,500 or $10,000 or something like that.
Okay. And let's talk a little bit more about the leverage. So let's say your typical loan is going to max out at 60% LTV. But could that even be on a purchase where the borrower has to bring in 40% cash, you put in 60, and as far as going higher than that, that's just kind of a rare occurrence, right?
Yeah, I would say it's rare for B and C class property. I mean, there's not a lot of A class properties that come into private money too often. But an A class borrower, A class property, or just somebody that comes in, like the quote I told you about that we quoted today at 8.991. I mean, the guy, it's a small industrial building. He was paying $2 million, putting $1 million down. Like he just came in here and said, "Hey, look, I only want to borrow 50%." So we gave him a great price. But that building, honestly, I would have probably done 65% of that building today for sure. It just wasn't requested from us. But yeah, typically 60%. But look at it, it's almost like an inverse in like cap rates. Like the lower cap rate property you're going to do, the higher LTV we're going to lending at. So it just kind of follows that. Same with the points.
And do you do a lot of deals that include cross collateral to achieve the 60% loan to value?
We have, I mean, we do. I mean, I think it's pretty common for private lenders to do that. Not my favorite thing to do. But, a lot of times, like the ones that come to mind a lot, we do a lot of reverse 1031 exchanges. And so, the property that they're going to sell oftentimes doesn't have debt on it or doesn't have a lot of debt on it, and they're going to trade into something else. So that's probably our most common commercial cross is a reverse 1031 exchange.
So if someone came to you and said, "Hey, I need to cash out equity. I may not have enough equity on this primary asset, but I've got equity in my house or I've got another investment property." Is that just something that's a little tougher to do because it just takes more time and it gets a little bit more complicated?
We can do it. We try to stay away from owner occupied stuff, even if it's a low LTV. It's just, even if it's for a business purpose, we try not to do much of that. We do some, but it's not our goal. We would rather just have standalone deals, but we do look at cross collateralization. We use it. I think we use it like most lenders use it in this space.
All right. And as far as the valuation, you mentioned that you don't do any formal appraisals. Are you doing a site visit for every property that you lend on?
Absolutely. So either me or someone on my team is going to definitely go to the property. That's part of the deal. There's no way we're going to lend on something and not walk it. I've seen too many crazy things over the years that would be like everybody who's been doing this long enough has seen. I've seen, it's almost like these dating apps. The picture doesn't match the person. So I've seen that a lot with real estate as well. And yeah, so and like the good thing about no appraisal, I mean, our speed's quicker, right? I mean, literally, the underwriting committees meet, and so I can, even in Southern California, I can jump on a plane, tomorrow and get down to some property and walk it, and we're not waiting for an appraisal. You don't have to pay for one. And like the other problem with, in my opinion, with appraisals is Well, until appraisers start writing checks, it doesn't mean anything. I mean, you just got a piece of paper with this, whatever company did the appraisal, they're not going to give you any money for it. And if the lender doesn't like the deal, they're just, doesn't matter what the appraisal says. They're just going to say, oh, we can't do it. So you end up, wasting time and spending money. But that's just how we roll.
And if you're going to do a site visit, obviously the borrower has to pay for that and all of your time. When you're underwriting the deal and before you do a site visit, how do you look at deposits and how does that typically work?
Yeah, I mean, we've been, DOC has always had room for people to do this, and we've always done it. We change it around, but in general, we say, look, here's our due diligence, non-refundable deposit. However, let's say you sent in your deposit and we never did anything. We'll send you all the money back. We just look at how much time we spend on it. It's not meant to be a profit source. And then any deal that closes, less travel expenses, and we outline things in our LOI, less that stuff, we credit it back. So even if like most of our deals, if it's a local deal, let's say they put up a deposit, they might get all but, $1,500 credited back to their transaction. So it's really not an issue once people have gone down the road with us. And once they've had the relationship, they understand how it is. And the brokerage community too has really come to like it because it's just, I asked a broker the other day that I've known for a long time, that's a really good broker at a major broker at Ridge House. I said, how many deals are you bringing that you have a actual agreement with the borrower prior to coming? 1 in 7. And so I can't tell you how many times that we'll get called from 5 different brokers on the same deal. And so you want to see these borrowers get some commitment to them if they're not going to sign your brokerage agreement. You want to see them at least pushed into a direction that there's some level of commitment. So it's actually, I think, been a good thing for brokers.
And from the lender's perspective, obviously you're taking the deposit at the time they sign the LOI, right? So you've already kind of done a let's say a quick evaluation of the deal in-house. You say, hey, we like it, we're going to put terms on it, and then if the borrower signs, then they pay a deposit, then they're committed and they're not continuing to shop the loan with other lenders and wasting your time.
Yeah, and in some cases, I mean, that's ideal, and it really has cut back on that because when I first got started in this industry, we kept doing all these deals and going all the way down to documents, and literally real estate brokers or the borrowers themselves would say, well, we just had you as a backup. We thought we could get bank financing. We had a hard deadline close. Just in case XYZ bank didn't close or XYZ credit union didn't close, we had you there if we needed. And I'm just like, you got to be kidding me. So that's when we started to move away from that model. And yeah, but like I said, it's not a profit source for us. We don't make money on deals that we don't close. Believe me, we're trying to close the deal. We want to close loans. I mean, we are in the business of doing loans. We are not in the business of just trying to collect deposits. And if we were, no one would call us. I mean, we wouldn't see as many deals as we see because people would know we're just pros. But I would tell you that it's a necessary part of a commercial underwriting, especially when you're jumping on airplanes and stuff like that. I can't front the cost of all these different people if they're not having some level of sincerity with us.
Sure. And could you give us an example of what a deposit might run? Let's say it's a $2 million deal. It's a local Bay Area deal.
We usually do 7,500, and we do 7,500 on pretty much everything. And it, unless it's a way bigger deal. And like I said, our typical, if they close the loan with us, I would say the average amount of money that goes back to the borrower is probably somewhere around 6,000. That's credited back. I'd say that's about average because our cost deal from loan to loan.
All right, makes sense.
Yeah,
Sounds good. Yeah, I mean, in commercial real estate in general and private lending, it is common to take a deposit. It's just a matter of what the amount is, whether the borrower is comfortable with that. I've seen commercial real estate lenders ask for a much higher deposit than what you do. I mean, maybe double, triple, quadruple the amount.
for
And
sure.
yeah,
I mean, and with that too, Rocky, I'll bring back up just because it's a point of emphasis for us. We're not requiring an appraisal. I mean, that's 3 or 4 thousand, 5,000, 6,000, $7,000, and they don't get that money back. There's no credit back on the appraisal. I can't tell you how many appraisals I've seen that just ended up it didn't do anything for anybody.
good point. And with the loans that you've that you do, being around 60% average LTV, do you end up doing any rehab value add deals or ground up construction?
We do. There's more rehab than ground up. Some ground up, but it's very selective. There are lenders out there that I will openly say are better to go to if you want a ground up construction deal, especially if you want max leverage. We underwrite everything to cash. I don't look at, you know, after repair value, which I know is a measurement that's very common in the lending world. And if you're doing construction loans, there's always going to be that component. Of course, we look at what we think the property's going to be worth afterwards, but we're really just looking at cash for the most part. I don't know. I mean, it's hard to say sometimes, and especially when you get interest rates moving the way they've been, up or down, whatever it's going to be, what the price and value of something's going to be in 12 to 18 months.
All right. And over the years, you've been in this industry so long and you're probably very well known in the Bay Area. Are most of the loans that you get, all the loan requests that you get, what percentage would you say are coming from brokers versus the borrowers directly?
A third of our loans are repeat borrowers. 2/3 come from other sources. Other sources, probably brokers would be the first, like the biggest bucket. Banks themselves would be the second biggest bucket. And then there's just a host of others. So trust attorneys, financial planners, commercial real estate brokers. I mean, we have a lot of commercial real estate brokers that invest in Rubicon Mortgage Fund. I don't know how many we have, probably 50. So, a lot of those people are sending us deals.
Nice. And let's get into some examples of some loans that you've funded in the past 2 years. If you could just give us a few different examples, maybe an average size commercial real estate loan, a larger one over 5 million, maybe a residential deal, one that's a specialty property type or unique situation.
So we did a loan just down the street from here. It was a 6 million, it was a little bigger than that, $6 million acquisition. Our loan was 3.9, so a little bigger. It was an empty former Walgreens, but it's really well located. It's going to be a redevelopment play for condos. Our area here in Lafayette, California, which is about, I don't know, 17 to 20 miles east of San Francisco. There's a lot of this redevelopment for condos up and down the main drag here in town. And so this was an empty retail building. They claim to have a tenant, whether they go down that route or just further entitle it and sell it or build it out, whatever. But that's a deal that we would look at that, it's an empty building. That's why we got it. There was also a international, foreign national, right? So it's a foreign national group, and from China, and that's a deal that we took on. That's I guess a little bit different. Lots of smaller, I'll say 6 to 10 unit apartment buildings, lots of little industrial deals, a lot of little owner user deals that we get a lot of owner user stuff. We're funding one right now in San Leandro. A guy for his own business. He's purchasing a building for, I think it's $1.8 million, and I think we're giving him $1.2 million or something like that. Yeah, $1.815 million. I think we're giving him $1.2 million. Owner user property, a little bigger deal that's a little more exotic. We had a really well-heeled group that came in here. They had a really big office building in Pleasanton that was 104,000 square feet, 52,000 square foot buildings on about 8 acres. It had all kinds of exit strategies. Home builders wanted to buy the land. There's all kinds of stuff. But the problem is it was about, I don't know, it was maybe 50% occupied. They have $13 million on it, which was a little rich for me on that product type. I said, look, if you can put in $2 million in cash, they had just purchased a multi-tenant industrial building for cash in the peninsula. I think they paid 10 or 11 million, 10 million for it. And I said, you can pledge those two, I'll give you 11 against gold. So there's your cross collateral. That was a bigger deal that we did about a year ago. They've been great, great followers. And then I'm sorry, so that was a bigger one, kind of an average one. Your last residential, was that what you said? Yeah, so local contractor, we just funded one here in Orinda. That's where I live. I've known this guy forever. You know, he's a local, he has a construction company, he does some residential brokerage, and then he also does, I'll say, kind of full scale remodel fix and flips. He's very active. So he just bought a property for like $1 million. I gave him 650 grand. And then his rehab costs are going to be about $1 million. I'll end up doing a second behind myself. We're still kind of a first, just so he doesn't have to repay all the fees, not only to us, but the title. And we'll do a second behind ourselves for another 650. So he's doing 35% of the cash. We're doing 65% of the cash. And we'll build in even an interest reserve as part of the cost and stuff like that for him, just because we know the area cold and it's a great spot and he does good work. So there's a residential wonderful deal that has a construction element to it. But that's a rare, the construction part of it's rare for us.
All right. And how about one in Southern California that you've done in the last 12 months?
We just put it down. It was down just north of San Diego. We just did a 2-unit retail building, kind of a banged up building. This guy's going to go in there and use it for his own business and clean it up. And he had a nice little portfolio. This guy, I don't know, he owned a bunch of stuff, 15, 20 buildings. And I think he just kind of does that same. He goes in and he finds opportunities where he can turn it around and not afraid to roll up his sleeves and clean it up. And I think that's where he finds his value add opportunity. And in that case, we provided him a 60% loan to cost, which is really standard for us. And I think we won the deal just because I think the guy didn't need leverage. And I think he chose to borrow less and pay less for it. And I think on that transaction, I'm going to say our deal size, that deal size was around $1.4 million loan or 3 loan or something like that. And I think on that quote, I think we quoted him 899 and 2.
All right. Sounds great.
Yeah.
All right. Let's switch gears and finish off the interview with talking a little bit about the company. Tell us about your operation, the people involved, loan servicing and things like that.
Yeah. So we're a 12-person company. The company was founded the management company was founded in 2005. And the mortgage fund was put into place in 2007, which was a really interesting time to start a mortgage fund. And so we have 12 people. We have 5 outside sales reps. We have inside, my CFO is also our in-house legal. She's both an attorney and a CPA. She does all of our inside legal as well as some other functions as the CEO. We service all of our own paper. We have 2 people in servicing. We have 2 people in docs, front desk person, marketing person. Um, and yeah, it's a full scale operation. Everything is under one roof. We all come to the office and all in one spot. We have one gal that's one of our better salespeople, Casey, and she's up in the Sacramento area. So she does, by her choice, work remotely. We're open to, salespeople working remotely, but our inside people, we want them inside.
All right. And tell us a little bit about the fund. I mean, you started in 2007. That's a long run. How many investors do you have? What's the portfolio like at this time in terms of the number of loans, the dollar amount?
Yeah. So the fund's about 150 million. We have about 325 investors. So I guess what is that? Average investor just under 500,000. But it's really more of like our minimum's 100. So it's either like a bunch of hundreds. Pretty much our investments go 100, 250, 500, a million. That's kind of what comes in. Everybody has the option of, they can reinvest every month or they can take monthly distributions. About 60% of our fund takes monthly distributions. The 40% that chooses to reinvest, most of that is IRA 401k kind of money. Because we don't have a conflict of interest. Most funds have a conflict of interest, meaning that their manager doesn't put all fees and interest and everything in the pot, so to speak. Most funds are set up where the manager takes the origination fee, pays out the interest to the investor, then sweeps back some sort of service fee. We're set up more like a hedge fund, which was I had a hedge fund for 14 years before I did a bit on the trading floors. So when I came to this business, I'm like, I don't even understand why investors wouldn't want to be aligned with their managers. To me, it was crazy. So we've always done it this way. So everything goes into the stoop, and about 60% get a check every month. About 40% we invest. Our average IRR to investor over 19 years is just under 7.5. So it's like 7.48%. But that's over 19 years. So.
All right. It's interesting that you have the name mortgage fund in the company name. I don't see a lot of private lending shops that do that, but I think it clearly communicates to the public that, hey, we're a mortgage fund. That means we're a direct lender. This is where the capital for your loan comes from. It's from our mortgage fund. Has there been any question about that where people say, hey, are you a direct lender? From my perspective, I would never ask that, but do you ever get that or any conversations about that?
We do. We definitely do. I mean, people that don't know us, like you say, when we're sort of getting interviewed, and I encourage brokers who haven't worked with a lender before to call them up a little bit. Like, I'm kind of surprised. I'll get a call out of nowhere from a broker who's never spoken with me. I'm a little surprised that they're like pitching me a deal, which is great. I'm not discouraging that, but I'm just surprised they haven't checked us out a bit because, we're easy to check out. We have a bunch of stuff online to look at, but I mean, your better brokers, they're gonna know where the source of money is coming from. I mean, obviously, look, there are people that do individual notes that would, they're going to defend their business. I mean, for us, I have won deals by, screenshotting, our count. Just, here you go. The money's in the bank. There's no outside appraisal. There's no outside legal. There's no outside servicing. So everything's in-house. I think that helps. Everything's really direct. But that's a really old school way of doing things. I mean, nowadays, other lenders may find it more efficient if they don't have enough business to do their own servicing. Then it probably makes sense for them to have outside servicing if you're not handling that much money. It's because we have people, we have staff. Like, if you're not to a certain scale, it probably doesn't make sense. Same way, I mean, we've always had inside legal. To me, that's a huge part of the business, but very few lenders have inside legal. And you say, well, what's the advantage of that to a borrower? A lot, because instead of every time that, like, sometimes borrowers are like, hey, we want to see the documents, 5 days before funding, we send it to them. We already know that means there's going to be a back and forth with documents between our legal and their legal. And we're not waiting for, turnaround time. Not that there's not law firms that can't work in real time, but I mean, for us, it's the most important thing. I mean, there is nothing else ahead of it. So we tend to be a little quicker in those sort of processes.
Love it. Well, Vance, that's all I had on my list. Anything I missed or anything you wanted to add?
No, I will just say though, Rocky, it's been fun to watch you and Private Lender Link, and I've always enjoyed, seeing you, and I don't know. I'm assuming I'm probably one of your first clients, and it's been fun to watch you go, and this stuff's been really cool. And I mean, it's a great service you provide to people. And I'll just say to other lenders out there, I mean, I get calls all the time for people looking for out-of-state deals, and I don't know that many out-of-state lenders, and I just send them over to Private Lender Link because I know that Rocky's done some kind of vetting for them. So I'm comfortable doing that. I'm just meeting some different when it's in-state and it's a product we don't handle because I know the person. But some of these people who I don't really know, I hadn't vetted them, so I'm much more comfortable pushing them your way.
Cool. Thank you. Really appreciate that, Vance. It's been a pleasure doing business with you all these years, and looking forward to many more. And that's a wrap for this episode of Private Lending Insights. Rubicon Mortgage Fund is listed on privatelenderlink.com. I'll put a link to their profile in the description. Visit their profile to find their contact information. You can call them, send them a short email form, or fill out a long loan request form. They pay us a monthly fee to be listed, so there's no fee for you to contact them through our site. I hope you found this episode to be insightful. Thank you for tuning in and listening all the way to the end.